All right, today we're going to talk about stock market mistakes, things that beginners often make when they start investing in the stock market. I've learned these lessons over 25 years. I've made some painful mistakes on my own, had to learn the hard way. So if you make it through the end of the video, all 6 mistakes, you're going to save a lot of money by not replicating those errors. So let's start with number 1. The first one's pretty obvious, just trading too much. When you're going into the brokerage account and you're buying and selling positions every day, every other day, every week, sometimes even every month, that's probably too much trading. You're probably not a professional day trader. Day traders in general don't make any money. You're having too many transactions. There's too much friction costs when you're selling a stock between the bid and the ask spread. That's how a stock price is determined. Somebody's bidding on what price they'd like to buy it, and somebody is asking for what price they'd like to sell it. That gap in the middle goes to your broker. So if you're trading a lot, that gap, every time you buy and sell, is being eaten up by somebody who's not you. And just to back up here, the whole point of investing in the stock market is that you are buying ownership interests in companies and businesses, or with real estate investment trusts, you're buying ownership interests in assets that produce a lot of cash flow. You're not just buying tickers on a screen here. Just because they're going up and down and blinking red and green does not mean that it's a video game. These are ownership shares in businesses. The market itself, with the day-to-day volatility being all over the place, is just a way to transfer easily those shares of ownership. So the idea is that you're going to be buying a business, you're going to be owning the business. You want to hold that for a long time. You wouldn't go buy a pizza restaurant, give them the money, own the business, and then the next day be like, forget it. You couldn't even if you wanted to, right? Businesses don't trade every day. It's a process. You're going to hold these things for a while. You're investing in it. You're not trading. This is not something you want to be doing and dabbling in and out. You want to make a commitment and keep that stock and see how it does over time. Because despite what anybody tells you, we have no idea what it's going to do day to day, year to year. But over 3-year rolling periods, 5 years, generally the cream rises to the top. Earnings grow at great businesses and the stock follows with it. So you're not trading, you're investing long term. All right, number 2. Second mistake is focusing on price too much. What does that mean? Well, don't I want to focus on price? It's not the price of the stock. It's not, 10, 12, 15. It's not that. It's actually the multiple on profits, the multiple on earnings that you're paying for. That is, quote, the price. That is the value that you're getting in exchange for that purchase price of the stock. It doesn't mean anything that the stock is 500. It means how many shares, what percentage of the company are you getting in exchange for that? In exchange for giving that company $500, and then they are giving you 1 share of the company. It doesn't matter if it's $500. It doesn't matter if it's a $1. It's just a percentage of the company. So stop focusing on the price, because the price is not going to tell you anything. It's not going to tell you that, oh, it's 500. Ooh, it's expensive. Oh, it's $1. It's cheap. It means nothing. So we don't want to focus on the price. We want to focus on the value. And a shortcut to focus on the value is thinking about the price to earnings ratio, which just means what you're paying for. The multiple on cash, the multiple on earnings. So the company makes $100 and you're paying a 10 PE ratio. You're paying a 10 multiple. Then $100 times 10, 1,000. That company's worth $1,000. That's the value equation. Number 3, looking at it too much. Even if you're not trading, but you're logging into your brokerage account every other day, whatever, just to see what your holdings are doing, that's a recipe for disaster, because you're ultimately probably going to obsess about it. And you might end up making a mistake. You might end up selling when the stock market's in a correction, in a bear market. But you want to be invested for a very long time. Maybe your retirement is 40 years away. Why would you care if there was a correction in 1 year? So you probably don't want to be looking at it all that often. Once again, if you bought a local business, you probably wouldn't be looking at the purchase price that you paid for that business every day. Number 3 is putting too much money into the stock market and not having a cushion for yourself, for your life, not having savings in a separate account. A lot of people make this mistake, is that they end up obsessing about the stock market and logging in every day because they can't afford for the stock market to go down 15% in a year, which happens all the time. In fact, every once in a while, it's going to go down 50%, right? 2008, it went down a lot. You need to be able to weather these storms. And if this is your entire savings and it goes down 50% and you're worried about paying the mortgage and paying your bills, yeah, I would probably look at that brokerage account too many times too, and then you're probably going to make a bad decision. That's too much pressure on your finances. What you want to do is you want to have a certain percentage, a large percentage, but a certain percentage of your net worth into the stock market, into liquid vehicles, and have other investments. And we always recommend having other investments that are not in the stock market, just to spread around the diversification. But my larger point is that if you have everything riding in the stock market and you have no liquid savings and there's no margin for error, there's no cushion in your financial life, that's a bad situation. You need to fix that, and because you need to give the stock market time and room to do what it's going to do without you panicking. So make sure you have a separate account of savings that's going to cover any surprises. I like to have like a year's worth of just cash sitting in the bank account. Some other people recommend 3 months, 6 months, but I don't know, just be conservative. Have plenty of cash available to cover your lifestyle should you get in a car accident, a health problem, somebody loses a job, what have you. Life happens, right? So have a cushion, but you definitely need to be invested. So just make sure whatever you have invested in the stock market is a number that you're comfortable with and is not to the penny all of your life savings. All right, number 4, the next mistake is really just ties to what we just talked about. This is getting emotional about the stock market, getting too excited, getting too depressed. Either way, not a good recipe for long-term success when you're investing. You want to be completely unemotional. And I know that's probably hard if you're an emotional person, if you're expressive and you get excited or you get depressed easily. That could be tougher for you. Maybe the stock market by yourself in individual positions is not your cup of tea. Or maybe you need help. Maybe you need a professional to help you get through this if that's your personality. But you don't want to get emotional. The stock does not care that you own it. It doesn't worry about the fact that it's down 25% because you put money into it one day. It doesn't think about you. It's just doing what it does. So you can't get mad at the stock. You can't get excited when Tesla shoots to 500 and mortgage your house and push it all in like you're gambling in Vegas because you're so excited and this thing is going to change your life. You can't get emotional about these things. It's very pragmatic at the end of the day. On a day-to-day basis, on a year-to-year basis, it's hard to predict. It's, like I said, it's volatile. But over a long enough time period, it's like clockwork. These stocks are going to follow the dividends they're paying, the earnings that they're making. Once again, it's going to be all over the place until that time, but eventually it's going to recognize and reward great businesses that earn a lot of cash. So just try not to get emotional about it. It's going to move around. It doesn't matter what your screen says your portfolio is worth on that given day. You own a stake in these businesses. All right, next mistake is not diversifying enough. This is putting it all on black. You put your entire investments in one strategy, one investment, one stock. Probably not a good idea. Sure, that is a way to make a lot of money. If you happen to get lucky and you pick that right company that goes to the moon, of course, that company could go bankrupt. That stock could go to zero, and there goes all your money. So you want to spread it around a little. There's a million different ways you can diversify. The key point is that you are diversified. You're spreading around your risk. You're not letting one investment dictate the entire success or failure of your portfolio. The next mistake is thinking that just because the stock is down doesn't mean it can't go down further. A lot of people made this mistake in 2022. I've certainly made it myself. You look at a stock, it's down 50% for the year, and you start licking your chops thinking, oh, this is a steal. This thing is cheap. How could it possibly go lower? Of course it can go lower. It can go to zero. If it goes from 10 down to $1, you think that's 90%. It's 90% on sale from its all-time high. What a steal. This thing is going to make me so rich. And you put your money thinking, how could it possibly go lower? Or even if it does, it's only $1. How could it go that much lower? How can I get hurt here? But guess what percentage loss is from $1 to zero? That's 100% loss. Yeah, it can go from $10 to $1, and that's a 90% loss. And if it lost another 50 cents, that would be a 95% loss. But if you bought it $1 and it went to 50 cents, you just lost 50% of your money. So once again, back to the second mistake, don't think about the fact that it's just, oh, it's $1. So stop thinking about the price or how much it's up, how much it's down. Here's another way to think about it. If you've ever been to Vegas, you know how you walk by the roulette table and you see the sign that has all the numbers and the color on the last 20, 30 spins of the wheel. And you'll see it'll be like 10 reds in a row. And then for some reason, more people are getting excited and they start betting because the next one, it has to be black. The next one has to be black. That stock went from 10 to 1. No way it can go lower. But guess what? That wheel does not know that the last 20 spins have been red. It has no recollection of history. Every spin is a unique probability event. It's going to be 50-50 every time. I guess it's going to be less than that because there's green numbers, but I don't know. I don't play that game. It's not a very smart game to play. So the point is that just like that roulette wheel, that stock, it has no memory. It's gonna do what it's gonna do based on buyers and sellers. And if the stock market, which is a large collection of very bright people making their own independent assessments on the future of a business, if the market decides that stock, that company is in real danger and might be going bankrupt, doesn't matter if the stock is $1. Doesn't matter if it's 50 cents. It still can go to zero. All right, the last and final mistake that beginning investors can't make in the stock market is using a lot of leverage, is using debt to try to boost their returns. If you took 50% debt on your portfolio, you had a $100,000 portfolio, you used $50,000 in margin debt. That's what it's called when your broker just gives you a loan basically to go out and buy more shares. 50% doesn't sound that huge because people are used to 80% mortgages on their house, but 50% margin debt is ridiculous for a beginning investor. That's playing with fire. It's a loaded gun for a retail investor to be playing with that much leverage in the stock market. Because like I said, the stock market can do surprising things. And if you happen to be unlucky when you took out margin debt, we have a big correction, because with that much leverage, it doesn't take much of a loss before that broker is calling you and saying, hey, guess what? That loan, we need more collateral because it's not doing too well. You've made some bad choices. So we're gonna sell most of your position and liquidate it in order to make sure that our loan is protected. It's called a margin call. It's not a fun call to get, right? You want to never get a margin call. So unless you're a professional investor, unless you absolutely know what you're doing, don't take margin. And if you must, just take a little, right? Just if you have to get your margin debt fixed, take a little, right? Margin debt can be a useful tool if you are a very high net worth person and you want to use that as a cheap loan without having to sell stocks, sell positions. You can use that margin debt to do other things in your life. But once again, this is for beginners, so let's just don't use margin debt. All right, so that was the major mistakes that most beginners make when they start to invest in the stock market. I've made a lot of these myself. I started investing when I was in my 20s. I made plenty of these mistakes. I learned the hard way. So hopefully some of these lessons were going to help you avoid these mistakes and help you be a better investor in the future. Thanks for watching.